God.
All right, thank God, it is Friday, and we may actually have a Treasury pick 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, we are poised for PMIs. S&P futures are paring losses ahead of U.S. manufacturing and services data. It's out later this hour, and we're going to do everything we can to make it exciting. The retail value play Gap and Ross stores see strong results as wealthier shoppers hunt for deals. And President-elect Trump names a new pick for Attorney General as the search for a Treasury Secretary drags on and on and on and on. We don't even care anymore.
Maybe today, though.
Let's take a look at where the market's trading. We could get it today. And Anne-Marie Horton does care, so we're going to talk to her about it. S&P futures, you can see, are off, but really that's unchanged. The same is actually true of NASDAQ 100 futures, down 0.2%. The 10-year yield also little changed, off 2 basis points at 439.82. So we need something to move these markets today. Or it's Friday. You could just chill.
Maybe we can all just go home. That would certainly be nice. But let's take a look at Gap right now, because it's absolutely soaring pre-market right now. That's after it reported an increase in wealthier shoppers, rather. It also raised its full-year outlook. That's good for a 19% surge. We'll see if that holds. Let's also talk about Intuit. It's lower right now after the maker of TurboTax, it's a tax reporter. Its results fell short of analysts' estimates. You can see shares currently down about 2%. And then we train our eyes on Alphabet. Not a huge move here, but it is a little bit lower on a report that OpenAI is considering developing a web browser that would be bad news for Google. A little bit of bad news for the stock right now. Alphabet shares down about 0.8%, Matt.
And maybe bad news for Intuit. I love to talk about taxes next to AI, because you should be using, hopefully we could be using artificial intelligence to do our taxes.
Yeah, can't the robots do my taxes? That seems like a natural application.
Right, but the problem is I don't even think the IRS understands the rules. So how could we train a computer? Let's talk about returns for a second, Katie. Come back over here. Come back over to the desk, and let's just chat quickly about the S&P 500 versus the MSCI World ex-US Index versus bonds. Really, the question that you posed yesterday when we were on Bloomberg Radio and television together is, why even bother trying to diversify? Because if you just put your money in the S&P, or I guess in the Qs, stocks basically in America, you're going to outperform everything else.
It's pretty amazing. I mean, looking at that chart, the S&P 500 in amber there, or orange, it makes me want to play eagle noises and maybe get some American flags, because you think about the might of the U.S. stock market. It's pretty amazing. And this is, of course, a one-year snapshot, but it goes back in time, too. And that conversation we were having about hedge funds, why you bother with hedge funds. I get it. You want to diversify. Occasionally, the line does go down, but very rarely, Matt.
Should we ask Andrew Slimmon?
Yeah, why not?
Let's bring him in. Morgan Stanley Investment Management Senior Portfolio Manager Andrew Slimmon joins us, and I'm sure, in good times, Andrew, your clients must be asking you this all the time. Why do I bother hedging? Why do I bother diversifying? Why can't we just put all my money in a stocks fund that beats everybody else anyway? What do you say?
Bring it on, Matt. That's what I say. Bring it on. I love it. But I do think, look, there's a couple things going on here. Is that, yesterday you saw the equal-weighted S&P start to outperform the cap-weighted. And that's because of some government, incursions into these big companies. And so there is an opportunity to move down the cap curve that's starting to appear. And that will help stock picking over, just pure S&P 500, kind of indexing.
Well, we've had this conversation before about how difficult it is to be a stock picker if your benchmark is the S&P 500. Well, let's talk about that a little bit. Talk to us about how active your active share has to be right now.
Well, look, I'm an active manager, and we've had a great last couple of years, and it's because of high active share. You can outperform and not own just the Mag 7, but I think what is happening now is you're getting a bifurcation of the Mag 7 where not all are working, And that will help stock picking as you move down the cap curve. It's easier to be overweight smaller companies that are in the S&P, and therefore your active share goes up. But I think what's really most important to consider here, Katie, is normally when you come out of a bear market like we had in 2022, small caps outperform, equal-weighted outperforms the cap-weighted. But it didn't happen this time. And I think the key difference is normally when you're coming out of a bear market, the Fed is cutting rates, and they didn't start cutting or announce they were cutting till July. And it was at the July juncture when the equity started to at least stay in line with the cap-weighted S&P.
Well, Andrew, you started down one of my favorite topics, and that is where you are when it comes to size. We were having this conversation with a portfolio manager from Goldman Sachs yesterday, actually, that you take a look at pure play active small cap managers, they've actually been cheating up. And like you mentioned, typically you go down the size scale to maybe find some extra alpha there. It seems like you're saying that there's a return to that more normal dynamic where you actually look into the smaller areas of the market to find those opportunities.
I think so, but I haven't been in that camp for a long time because I'm just trying to outperform, and I could see that the size factor was outperforming from really the October 22 low, but that is starting to change. So as that changes, that frees up the opportunity to move down the cap curve and start to pick away at some smaller companies, at least for what I do in the S&P. But for smaller cap, I think smaller cap will outperform. Look, animal spirits are coming back to the market. People are talking about, oh, financials are working, value's working, and that's true. But go look at how the darlings of the 2021 roaring bull market and big growth are doing. These are not, it's not just Tesla and MicroStrategy. There are a lot of these go-go growth stocks. They have taken off since that July cut. So I think the stock picking is going to be more speculative in nature, and that means stocks other than just buying the Mag 7.
Andrew, if we back out and just look at the index, the cap-weighted index here, we hit 6,000 and overcame that for a brief moment. We dropped back down, but it looks like we're heading back towards 6,000 at 59.48. When Trump comes into office, when we start to get more certainty on policy, I mean, is there really still reason to be bullish into 2025?
Well, it's still November, Matt, and so we got another month, and then we have until Inauguration Day, 3 weeks. And I think I just have a hard time seeing any substantive pullback in the market till after the inauguration. We're in the honeymoon period for any president. And then once they start to put pen to paper and you realize that not everything's, perfect, that's when the market tends to pull back. So I just don't see much of a pullback in the market until at least, kind of February. So yeah, I think markets tend to rally between, now and January about 75% of the time. I think people are still looking for ways to invest. If I talk to our wealth management advisors, they are telling me that the same clients that told them they didn't want equities 2 years ago, even though they're still in equities, they want more equities now. So it is a more speculative time in the market, and I don't see a pullback in that until after Inauguration Day.
Are there certain industry groups that you think are best poised to outperform? I mean, I know, typically in the last quarter, the market rallies, I think, more than 4% on average. In January, since we did tax loss harvesting in December, we go back and buy the stocks, and that gooses the index a little bit. But are there pockets that you think are better than others in terms of that Santa Claus rally and the January effect? Well,
I think if I look at opportunities, financials, I love financials. We have a big weighting in financial worth, its biggest overweight, but they've gone through the roof. And so to stand here today and say, Matt, you got to buy, money center banks and the asset manager, I think that's a really hard thing to do at this juncture. So what has not participated? One thing I think is the bond market is very oversold. Yields have gone up on this expectation that deficit's going to go through the roof. It's all spend, spend, spend. If there's any relief in the bond market, I think some of the areas that have lagged like the home builders, I think they would come back strong, or REITs. So the opportunity that has not participated, but I think would in if the bond market would calm down, would be the interest sensitive areas. I think that's an intriguing opportunity as I sit here right today.
All right, Andrew, that's a good place to leave it. Always great to speak with you. Have a great weekend when you get there. That is Andrew Slimmon of Morgan Stanley Investment Management. And Andrew did remind us that it's only November. But to the question that you asked, there was an interesting data track note out this morning. I'm sure you've heard of data track.
Yes, of course.
Nick Kolas posed the question, how will the S&P 500 perform in 2025? The easy answer is up 10%. That has been its average price return since 1928, which kind of ties back to that chart. Why bother with anything else? Yeah, because we're in, I think his argument is the third year of a bull market, and he looks back at the historical performance. But of course, we have a big it's different this time coming up in 2025 with President Trump in the Oval Office for the second term. It's similar to what we already got, but it's different this time. And of course, this is a very expensive market. We'll keep that conversation going. But let's get a look at what's moving underneath the surface right now. You can see the S&P 500. It's very quiet. So too are the NASDAQ 100 and the Russell 2000. So to take a look at some of the stocks moving ahead of the opening bell, here's Abigail Doolittle. Well, one stock that's moved into the top 100 stocks for the S&P 500 because of its meteoric rise this year, MicroStrategy, today up 1%. Earlier, it had been up a bit more, but this after falling more than 16% yesterday, the worst day since August. At the lows yesterday, the worst day since, I believe it was 2022. This, of course, as Andrew Leff put out a short report basically recommending a pairs trade, long Bitcoin, but use MicroStrategy and its principal position in Bitcoin as a bit of a hedge. But today, the stock recovering a little bit of that loss. Turning to the shares of Elastic, you can see they are soaring up 23%. The software company put up a great quarter. The analysts are saying points of stabilization. They also raised the view. And then finally, speaking of raising the view, NetApp, the storage company, also higher, up 7.6%. One analyst calling the quarter flawless, investors liking it, and you can see that on lifting the view as well as that great quarter, the stock up almost 8%, Matt. All right, Abigail, thanks very much. Abigail Doolittle talking to us about some of the individual movers ahead of the opening bell. We still have about 18 minutes to go. Coming up, Matt Gaetz is out as Pam Bondi becomes the president-elect's new pick for Attorney General. All the details next, and I'm sure we'll get into some kind of conversation about whether or not Trump is going to pick a Treasury Secretary. It's coming. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. Euro area business activity unexpectedly fell in November, leading traders to ramp up bets that the ECB will continue easing. Manufacturing slipped deeper into recession, while services saw a steep deterioration. The euro weakened to its lowest level against the dollar since 2022. The U.S. is examining J.P. Morgan's ties to an Iranian oil trader. The Treasury Department is probing the bank's relationship with the hedge fund Ocean Leonid Investments. Last month, Bloomberg reported that the fund was part of a network overseen by Hossein Shamkhani, the son of a prominent advisor to the Iranian supreme leader. No comment from J.P. Morgan, Ocean Leonid Investments, or the U.S. Treasury Department. And DirecTV has called off its takeover of Dish after it failed to win the consent of bondholders for a key debt exchange. Dish has not initiated fresh discussions. The merger would have created the largest U.S. pay TV provider, with DirecTV assuming $9.75 billion of debt. Katie? All right, well, that leads nicely into your favorite topic, and that is the fact that we are still awaiting President-elect Donald Trump's pick for Treasury Secretary. The Wall Street Journal reporting that Trump is considering former Fed Governor Kevin Warsh for the role. We've been talking about him for a few days. So let's get more now from Bloomberg Surveillance co-host Anne-Marie Hordern, and that's half of it, right? He's considering Warsh for Treasury Secretary and then maybe Fed Chair.
Yeah, so this could potentially be musical chairs when it comes to Treasury and the Fed and NEC. And we've been reporting on this before the Wall Street Journal, by the way, came out with their front page story today, that one idea that individuals around Trump potentially liked, because everyone knows that Kevin Warsh actually wants to be the Fed chair, is that you put him at Treasury till 2026 when Powell's term expires, and you put Scott Bessent at NEC. And then in 2026, everyone moves Treasury to Fed for Warsh, and then West Wing to Treasury for Scott Bessent. But I would still say the decision is not made, and potentially we're going to get the decision today. And what we've seen in the past 24 hours is the likes of Steve Bannon on War Room coming out and saying from the very beginning, we thought a safe pair of hands is Scott Bessent as Secretary of Treasury.
Yeah.
What I would say is Scott Bessent at that moment, and amongst all these people, has the support of the base, of MAGA, those senators. So, and like the likes of Steve Bannon,
So why
as well
bother?
as Steve Schwartzman. So, yes, there is this idea that maybe it could be Warsh at Treasury, Bessent at NEC. I'm just going to say we don't know yet. And there's been a lot of momentum in the past 24 hours behind Scott Bessent as well, who's been there since the beginning.
I just don't understand why bother with the musical chairs. Why not just put Bessent at the Treasury from the start? If you want Warsh at the Fed, you can hold him at NEC. I mean, is this all just because Lutnick got together with Elon Musk to try and stab him in the back?
Sort of. It became really this very tense situation with the transition. Howard Lutnick wanted this job. It then became a very much so a two-man race between Scott Bessent and Howard Lutnick. And to diffuse it, they brought in these other names. And then Howard was given a job. Mr. Lutnick will be going over to the Commerce Secretary. And if you look at that press release, he's actually getting an expanded role when it comes to the idea of trade and tariffs. That press release, even though not quite sure how that's going to actually work given the legality of it, but it said that USTR would be reporting up to him. I think the signal there is that this is going to be Trump's guy when it comes to going on TV, talking about negotiations, what it means for trade. So that either leaves, the tension has either dissipated and Scott Bessent could rise to the top of the Treasury, or potentially there is going to be this off-ramp where everyone is happy and you could have maybe a Warsh at Treasury, Bessent at NEC, or there's still dark horse, Mark Rowan. What did we hear yesterday with Ken Griffin sitting down with Sonali saying, Mark, please take this job? And then Senator Haggerty as well has been floated for a number of cabinet positions. Could be someone that pretty much everyone agrees on.
So you talk about Mark Rowan as a dark horse, but you think about the Matt Gaetz experience, and we'll get to Matt Gaetz. But Matt Gaetz being named for Attorney General, no one was expecting that. Is it possible that the names that we're talking about, that we could get a true dark horse and it's someone that we haven't even had on our radar?
Well, given how we've seen other names fill nominations for cabinet positions, 100% yes. But this is really important to the president, and he seems to be spending a lot of time with these individuals. We're going to get, I think, an announcement as soon as today. Of course, it could be someone we're not discussing, but that would be definitely something out of left field, definitely a dark horse. But you mentioned Matt Gaetz, 2 attorney general nominations in 8 days.
Oof.
Because the votes were just not there for that man.
Yeah, it's amazing that that was only 8 days, because it feels like so much longer. But maybe as soon as today for Treasury Secretary, you have a busy couple of days ahead of you. That, of course, is
Busy
Anne-Marie.
weekend, Anne-Marie.
Busy weekend, no days off.
She's used to it.
Anne-Marie Hordern, of course, Bloomberg Surveillance co-host. Let's bring you some breaking news really quickly here, and that is that Amazon is investing an additional $4 billion in AI firm Anthropic, boosting its stake in the OpenAI rival. The cloud computing giant pumping this in. This is according to a statement that Amazon put out. You can see Amazon shares rising a little bit right now, Matt, up about 0.7% here.
Yeah, it's interesting how much money is needed to train these models, right? You've got to sink a ton of it right now into NVIDIA chipsets and servers and, as we know, plumbers and concrete people.
We learned all of this, of course, at Bloomberg Intelligence's fantastic AI conference this week.
It was really good.
It was really good. And just to bring you that headline again, Amazon, another $4 billion in Anthropic. We'll discuss all of it and what's going on in the market up next. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. We're taking a look at futures right now. You can see the S&P 500. It's pretty quiet, down about 0.1%. We will end this week on a positive note unless something amazing happens between 9:30 and 4 p.m. today. You take a look at the NASDAQ 100, down about 0.3%, even though you do have Amazon moving a little bit higher right now on that breaking news that it will invest an additional $4 billion in Anthropic. That's an open AI rival. And then you take a look at the Russell 2000, the small caps resplendent right now. The Russell 2000 up about 0.3% pre-market, outperforming once again, Matt Miller. You have to ask the question, of course, how much juice is left in this trade, and are interest rates coming down to support it?
Yeah, I don't know about small caps.
Yeah.
That's really your realm. I do know that this is the Amazon headline is the kind of thing that could wake up some animal spirits. And if you look at on the terminal, most U4 is the function used to see the pre-market movers filter out for only companies that are worth more than $50 billion. Because I don't bother with Russell 2000. You see Dell is up 3%. Snowflake is up 2%. Salesforce is up 1%. So these kind of AI adjacent stocks are starting to move a little bit higher. I note the Dow Jones Industrial Average is back up over 44,000.
Oh, come on.
So
you pay attention to the Dow pre-market,
yeah,
but
because
not
if
the
I
Russell
type
2000?
WEI go on the Bloomberg terminal, the home screen for stocks shows me first the Dow Jones Industrial Average, then the S&P 500, and then it starts to go into like Brazilian stocks.
Yeah, I need to send some emails about that. I feel like the Russell 2000 deserves a little bit more respect. But in any case, coming up, we'll take you to the opening bell and take a look at all the stocks that are making moves. This is Bloomberg.
All right, we're moments away from the start of trading on this Friday and starting to see a little bit more movement in these indexes. Here you can see the S&P 500 futures still unchanged. NASDAQ futures down about 0.2%. But under the hood, I'm telling you, some of the individual movers are shifting after the headline from Amazon that they'll invest another $4 billion in Anthropic. You hear the opening bell at the NASDAQ and the New York Stock Exchange. If you look down at the NYSE, you're going to see UGP. So this company is a Brazilian holding company that moves gas and chemicals around and stores them. Actually celebrating its 25th anniversary at the New York Stock Exchange, but its stock is down 40% year to date and 40% over the last 5 years. So it really hasn't done well. Hopefully this will be the boost they need. Thumbs up at the NASDAQ market site. I think it's some kind of social media thing where they basically bribe customers to like their posts. I'm not accusing anyone of bribery, but I think you get paid over Venmo or PayPal if you like the posts, something like that. I'm too old to understand this sort of thing. Katie, please save me in terms of thumbs up.
I'm not going to try to explain it. Let's talk about the stock market because we're about 50 seconds into this trading session. On this Friday, it's the end of the week, and you can see it's a pretty, at least quiet for right now and to the week. The S&P 500 up slightly, emphasis on slightly. The NASDAQ 100 down slightly. It's been an interesting week. We will end with gains, but not enough to offset what we saw the week before, down about 2% on the S&P 500 last week, up about 1.3% at the moment. Then you take a look at the small caps, of course. The little guys really leading the market over the past couple months. That is the dynamic, as you can see today as well. The Russell 2000 up about 0.3%. But let's peek under the hood. Might explain some of the weakness that we're seeing in the big tech index. TurboTax maker Intuit. It's lower. That's after it missed its analyst estimates. Investors disappointed by the company's new AI products. You can see that disappointment in the shares right now. And breaking just a couple minutes ago, Amazon says it will invest an additional $4 billion into the open AI rival Anthropic. AWS will become Anthropic's primary training partner for its AI models. Traders trying to decide what to do with this news. The stock was higher by about 0.7%, now back to unchanged, Matt.
Got to spend money to make money. Katie, Amazon knows that more than anybody else. Gap, the clothing store, higher after boosting its annual sales forecast. For a deeper dive into the retail sector, we go over to Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, let's start off with Gap because it's really pretty interesting. And there's similarities between the Gap and Walmart, if you can believe it. Gap really had a great quarter and the outlook looking good because apparently wealthier consumers, higher income consumers going to the Gap stores, the various Gap stores, Old Navy, Navy, Banana Republic, and Athleta, and of course the namesake Gap for value. You can see the stock absolutely soaring over the last 2 days, up 22%. So yesterday up about 6%. It seems as though some folks knew about that quarter. Let's take a look at what investors really like, though, and that's the fact that they boosted the guide, the old guide for the full fiscal year, less than 1%. That could be anywhere from 0.1% to 0.9%. The new range, the high end, 2%, 1.5 to 2%. So not big numbers, but going in a better direction than it had been. But let's broaden it out to retail. It was also Ross Stores has put up a good quarter, better than feared. Some are saying the outlook has stabilized, up 5.4% on the week. There's Walmart, that good quarter again, and boosted the view on the higher income consumer going there for value. These are 1 week views. And then Target, on the other hand, or Target, I should say, because that Target feeling clearly not there, down 19.4%, dismal quarter, missed estimates in a big way, slashed the view. And then Lowe's, they also had a little bit of a tough time. So we still have this bifurcated consumer. And it seems we also have tales between different retail stores where some are operating better and some a little bit less well, Katie.
It is just stunning to see that move in Target. Like you said, maybe they should get back more of those Target vibes, but in any case, down 19% in a single week. Abigail Doolittle, thank you. And let's broaden out this conversation now with Marianne Bartels. She is Sanctuary Wealth Chief Investment Strategist, joining us now. And Marianne, going straight to this line in your notes that we are estimating the S&P 500 at 10,000 to 13,000. That's a return of 70% to 100% before we see a peak in the market. For context, we're just below 6,000 right now. When you think about some of those big numbers, what kind of time frame are we talking about?
So that's not my forecast for next year.
Okay.
Let's be clear. We still believe we're in a secular bull market. And I don't think this secular bull is going to peak out until 2029, 2030. And I do think we can get to 10,000. I remember when it was big when the Dow hit 10,000. And I do think in this cycle before we peak, we can get to 10,000 on the S&P 500. Now, for next year, my forecast is still very bullish. I'm at 7,200 to 7,400. I like to have a range. And so why am I so bullish? I do believe that this technology of artificial intelligence and blockchain is going to be transformative, not just to our economy, but to global economies. And we went back, and there's a lot of talk about the mid to late 1990s, like 95 to 2000. And we did find a lot of parallels that are similar. We also went back to the 20s and looked at 1925 to the peak in 29. We also found a lot of similarities. So the theme of our year ahead report was all that's new is old. We have had technological transformations before. It created a very strong economy, created strong corporate profits that really surged equity prices. And I think we're right in that sweet spot right now.
So I wonder, Marianne, I always think of you as a technical analyst. I think that's what you're famous for, but you studied economics, you're talking fundamentals. How much of this is fundamentals versus technicals?
It's really a blend. It's 50-50. I spent many years as a quant, and I always want to be a strategist, so here I am. I'm blending everything together. And what I found is when the fundamentals and the technicals match, I have very high conviction, and I think that's what we have. I do believe the technicals get to this level. It's certainly hard to do projections for earnings going out the next 5 years, but the technicals actually get you there. So you have to back in and say, well, how are we going to get there? Well, we have AI and we have blockchain, and we haven't even really talked about blockchain and the transformation that technology can have on our economy and our markets. So again, the technicals, fundamentals, I think they're all aligned. Tech is still the leader. In fact, when we looked at the return on equity, the return on equity for the tech sector is 31% compared to the S&P. The earnings are coming out of these tech companies. So I know there's high valuations, but they're supported by earnings.
So that's really fascinating. I want to dig into the fundamentals a little bit more. It sounds like you're saying it's tech that leads us there. What happens to the rest of the market, though, on this march to 10,000 potentially?
It's all tides lift everything. So I think the whole market will generally come up. One of the things that we're optimistic on is maybe small cap can actually perk up here. I don't think they're sustainable leadership, but we have good seasonalities. They are less expensive. So I do think over the next 12 months, you're going to continue to get a broadening out. I think small cap can play a very big role in that. Infrastructure is very big. We need infrastructure build out to have AI. That's the industrials. The sectors that really look sick to me are healthcare and consumer staples. I'm really not seeing anything in those sectors at all. Eventually, maybe utilities, but as long as the back end of the curve, the 10-year remains elevated, it'll struggle for utilities as a sector. But those utility companies like Vistra and Constellation are doing phenomenally well in this market.
You mentioned blockchain. Katie doesn't want to talk about it. I have to bring it up.
I have an open mind. Let's go.
Well, look, you can't deny that the Bitcoin trade, first of all, XBT currency. It always kind of makes me giggle when I put currency because I no longer think of it that way. But the Bitcoin rally has been insane. We were up to 99,500 and change today. We're back down a little on Bitcoin. This is an interesting chart that Dan Curtis put together out of London. It just shows that the smaller, higher risk coins have traded up faster than Bitcoin over the last couple of weeks. But the rise of Bitcoin is undeniable, Marianne. What do you see in this, $100,000 token?
So we did see earlier this year, we did project 100,000. We're up there. Now, typically when we get to important big round numbers in markets, you can struggle a little bit to get some backing and filling. But we do think we'll break through. The first technical target, once it breaks 100, will be 113 and then 150. So I'm not doing the very long-term projections because you can easily do that based on supply and demand. There's only supposed to be 21 million Bitcoin printed. We have 8 billion people in the world. You can do the math just that way.
Do you own it, Marianne? Do you own Bitcoin?
I do.
Good for you.
For full disclosure, I do. And there are other tokens I also own. I became fascinated with crypto after I retired from Merrill Lynch and Bank of America. I always felt that Bitcoin, that there was something there. I'm a big Trekkie fan. And I really believe that we were moving to a digital world for currency. And I think Bitcoin, I don't know if Bitcoin will be that currency, but I believe that it's symbolic of that we're moving to an electronic form of having a currency.
Marianne, let me just for disclosure, I'm not like a crypto hater, and I do think it's useful. You mentioned the technicals. I have to imagine for a technician, that's a dream asset class. And it's a really interesting measure of risk appetite. Marianne, great to speak with you as always. That is Marianne Bartels of Sanctuary Wealth. I know that you're a big crypto guy.
I mean, I have loved it from day one. Just the kind of the community around it, the libertarian bent.
Yeah.
I like these kind of fun Reddit-based conspiracy theory things, and Bitcoin falls into that for me. Also because of the reasons that Marianne said, I find it interesting, but because I'm a journalist, unfortunately, I did not ever make a big investment in it, so I don't own any.
Well, the good news is that you didn't, and you get to work here at Bloomberg News. Coming up, retail stocks getting a boost ahead of the holiday shopping season. We'll discuss who's hot and who's not next. This is Bloomberg. All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Piper Sandler says the solar energy company Sunrun is no longer a buy and cuts its recommendation to neutral. The analyst says that the company may need to cut costs and increase prices if the Trump administration alters subsidies in the Inflation Reduction Act. Next up, Raymond James is cutting HCA Healthcare along with Tenet Healthcare and Community Health Systems, citing potential headwinds ahead for the group. The analyst says that there will be a likely reduction in the Affordable Care Act exchange population because of sunsetting of subsidies in 2026. And finally, we have Needham initiating coverage of Crocs with a buy rating and a $116 price target. The firm says that the stock has been overly punished in recent months and says that he's encouraged by the company's talent investments this year. Crocs tapped former Yeezy shoe designer Stephen Smith as its new head of innovation earlier this week, Matt.
Yeezy. All right, we got PMIs out, and on the services side and composite side, they're better than expected by a lot. We were looking for 55 on services PMIs, and we got 57. So that line continues to climb. If we pull up Dan Curtis's chart, you'll see that services continues to increase. Manufacturing, on the other hand, getting a little bit better than the previous forecast, the previous print, but a little bit worse than the forecast at 48.8. It does continue to climb. I guess this chart hasn't updated yet because you'll see the blue line jump higher and the white line will edge a little bit higher.
Would the white line be above the yellow line?
No, not yet. And that indicates that we're still in a contractionary period in terms of manufacturing. Above the yellow line is expansion. The interesting thing will be to see if the next Trump administration or the sort of post-election time period really moves those numbers significantly. It certainly looks to have done so in services.
Yeah, absolutely. Hopefully we'll get an updated chart on that soon, but a really interesting dichotomy still in our economy that it's all about services, not as much about manufacturing, though you do see a little bit of a recovery there. Let's talk about retailers, though, because two retailers in particular have a reason to feel optimistic ahead of the holiday season. Gap and Ross stores both higher this morning after reporting their latest results. Let's break it all down with Emily Cohn. She is Bloomberg consumer editor. It feels like for Ross stores, it was a better than feared sort of vibe, whereas for Gap, there's a real recovery and some real excitement there.
Yeah, I think we're seeing this continued story that we've seen all week of this. There are two different consumers that we're talking about here, right? On Gap, they're seeing gains, share gains from the middle and upper income shoppers. Households that are making more than $100,000 a year are trading down to Gap and Old Navy where they know they can find value. We heard almost the same exact thing from Walmart this week, and it led to huge share gains there. Interestingly, we're also seeing other share gains this morning from retailers like Urban Outfitters and Abercrombie and Fitch are both up with Gap. On Ross, this is a different consumer we're talking about, right? This is a discount retailer, and we're seeing other discount retailers like Burlington up this morning. So again, this speaks to this bifurcated consumer where we see the wealthier consumers trading down for value. And on the other end of the spectrum, we see some higher end retailers where consumers are seeing more bang for their buck and value pop. This is what we saw earlier this week when Target reported its down report. We saw Williams-Sonoma and Happier News pop. So we're seeing this bifurcated consumer where people are really trading down for value.
And I mean, you know, Ross hasn't had a fantastic year. It's up, I think, 7% and change year to date. Gap is up a little over 13% year to date. Neither one of them really keeping up with the huge gains at Walmart. Is that just a story of scale, or is it something to do with the consumers that are going to these other two stores?
Yeah, I mean, Walmart just has this advantage of having everything. So a lot of the things that when people are feeling pinched, they're prioritizing essentials, right? Like you have to buy groceries. Groceries represent 60% of business at Walmart. So even when people are trading down, they're still buying essentials. They're still going to Walmart. And I think we saw a winner there this week with Walmart doing much better than Target in that event.
Yeah, big time. A big winner in Walmart, a big loser in Target. Target down about 19% for the week. That's going to leave a mark. Emily Cohn, great to speak with you. Have a great weekend. Now,
Thanks,
coming
you
up,
too.
Ken Griffin makes his case against tariffs at the Economic Club of New York. Highlight from our interview with him next in today's Wall Street Beat. This is Bloomberg.
Citadel CEO Ken Griffin making his case against tariffs. He spoke with Bloomberg's Sonali Basak, our co-anchor, at the Economic Club of New York.
I am gravely concerned that the rise of tariffs puts us on a slippery slope towards cronyism capital. So when you implement tariffs, For the American companies that produce goods in America, there's unquestionably a short-term benefit. You've just taken your competitors and severely disadvantaged them. The challenge with this, and we know this from the history of economics, those same companies that enjoy that momentary sugar rush of having their competitors removed from the battlefield soon become complacent, soon take for granted their newfound economic superiority, and frankly, they become less competitive on both the world stage and less competitive at meeting the needs of the American consumer. And then, of course, once you're in this world where companies know that their very existence is because of tariffs, in other words, if the tariffs came down, they wouldn't be able to compete, they wouldn't be able to thrive. Now you're going to find the halls of Washington really filled with the special interest groups and the lobbyists as people look for continued higher and higher tariffs to keep away foreign competition and to protect inefficient American businesses that fail to meet the needs of the American consumer.
Are you concerned here that some companies, some industries will be benefiting at the expense of others, even in this country?
Well, of course, that's true, right? Those companies that bring in goods from around the world will be disadvantaged out of the gate. Those companies with a very large domestic production base will be advantaged out of the gate. I'm not so worried about I should be more worried about it, to be blunt. I haven't given much thought to sort of the internal equity as between these parties in the United States. I'm much more concerned that this is the beginning of a slippery slope towards economic, both irrelevance and going back to the earliest point, a decline in productivity, a decline in the very important need that we have to increase American productivity.
That was Citadel CEO Ken Griffin and Bloomberg Sonali Basak in a wide-ranging and I thought really fantastic interview. Griffin was very forthcoming about his thoughts, both positive and negative, on the Trump administration.
Yeah.
But I thought it was interesting that he's worried about a slide into crony capitalism, as if we're not already there.
That's true. That is a good point there. And I mean, he makes a very thoughtful, nuanced argument against tariffs, why we should maybe proceed with caution there. I don't know if anyone in the incoming administration is necessarily listening to that, though. You know, these arguments against tariffs, you know that Trump calls himself
a beautiful word.
Tariff man, I believe.
Yeah.
So we'll see. He also, of course, said that he would be open to selling a stake in Citadel. That is the $65 billion multi-strategy hedge fund.
That was fascinating.
That was very interesting. We saw something similar from Millennium, for example, and clearly Ken Griffin is thinking about it, too.
Yeah, Millennium with BlackRock, and he was praising Izzy Englander and Larry Fink.
Yeah, he spent a lot of time doing that.
For what they've built, but I really thought his explanation about why multi-strat hedge funds have kind of seen their day was really interesting as well. Just a great piece to go back and look at. I think you might have to join the Economic Club of New York to actually see the full thing.
Yeah, I'm not quite sure. But in any case, let's take a look at these markets right now. It's a Friday. It's been a busy week, and you can see we're still getting a little bit of a lift when it comes to the S&P 500, up about 0.3%. Can't exactly say the same yet for the NASDAQ 100, but stay tuned. We have a double dose of CEOs coming up in the next hour. We'll speak to the CEO of Manulife and SharkNinja. That's coming up. This is Bloomberg.
We are 30 minutes into the trading day on this Friday morning. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. And coming up, what stock is trading more than both Bitcoin and Nvidia? It's wild times for MicroStrategy, and we'll tell you why. And the exit interview. We'll have an exclusive conversation with Gori. He is the CEO of Manulife as he charts a new path. And taking the pulse of the U.S. consumer before Black Friday, we'll speak with SharkNinja CEO Barrocas later this hour. Before we get there, though, let's take a check on these markets. Like Matt said, 30 minutes since those bells rang, and we have green on the screen, at least for right now. The S&P 500 up about 0.3%, 0.1%. The NASDAQ 100 lagging a little bit, down about or up about 0.1%. But we do have Nvidia shares a little bit lower, a bit of a tug of war going on there. The bond market pretty well behaved at the moment. You have yields a hair lower. We're camped out around 440 right now, Matt, and we know we've been pretty close to 4.5% in the last week or so. So maybe a little bit of a sigh of relief right now on this Friday.
MicroStrategy owns 331,200 Bitcoin.
It is insane.
It is nuts. But that's only like a $31 billion chunk of change, right?
I know.
And the market cap of MicroStrategy
it's three
is
times that.
$100 billion.
Yeah, it's pretty amazing. I think about the bull case for Bitcoin, and one of the real bull cases is that Michael Saylor is going to buy every available Bitcoin. That is his life goal.
There's a guaranteed buyer.
There you go.
All right, let's talk about the rest of the market right now. Joining us is Ancora portfolio manager David Sowerby. David, great to have you on the program. Again, I want to ask your take on U.S. stocks. Katie and I kicked off the show looking at U.S. stock performance versus the rest of the world in the MSCI World X-USI Index, or versus bonds, or really pick your asset. Outside of Bitcoin, it's been the best performer. Why bother owning anything else?
That's the key. Portfolios should have a heavy bias to U.S. stocks. It amazes me when some of these investment committees I work with and will say, well, if you don't own non-U.S. stocks, you're limiting yourself to 50% of the market. But the facts are quite powerful. Since late 1987, U.S. stocks have compounded 5 percentage points better annualized than developed markets. The batting average for their success is close to 70%. It's a reflection of the health of U.S. companies' ability to deliver shareholder value, which compares so much better to, for example, eurosclerosis and pockets of Asia that just aren't keeping up with the U.S. market. Heavy bias to U.S. large cap and small cap stocks.
Are those criteria that make U.S. stocks a best performer historically set to expand with Donald Trump in the White House for a second term? Do things get even better for business? As I think Ken Griffin said, we're going to get back to the business of doing business. Do you believe that?
On the margin, yes. Animal spirits will be rejuvenated. Watch when that small business optimism index comes out in the next couple months. It had a big bump in 2016. It had a big bump in the early 80s in the Reagan years. So for the most part, sensibility on regulation, potential to have tax cuts be more permanent. Sadly, Econ 101, tariffs get a bad grade. I don't get that. It's simply Econ 101, but for the most part, the U.S. will be the right place to be an investor in.
Well, on tariffs, you are in good company because Ken Griffin, of course, agrees with you there on the tariff piece. I want to go back to this idea of diversification, though, and that question, why would you own anything but U.S. stocks? You make the point that, of course, U.S. stocks have been the outperformer. Can you lump fixed income in there, though? When you think about a diversified portfolio, do you need fixed income, or is that just a weight?
You do as the shock absorber, but you want to play offense there as well. So as an example, in my portfolios, I own Ares, which is private credit, bank loans. You're getting yields of 10%. It's a pretty good competitor to the U.S. stock market, better than non-U.S. equity markets. So I think sensibility and fixed income with a little bit of octane and private credit is the right solution as well.
That's really fascinating. Just to clarify, you own Ares stock, or are you invested in the bond somehow?
I own the stock because of the long-term probability that private credit is in the fourth or fifth inning, and it has a long cycle ahead of it, and that's why I own Ares.
Stock's up 50% year to date.
Yeah, there you go.
So good for you, David.
Well, David, if you own Ares, you're bullish on private credit. Does that pair with maybe a little bit underweight on financials? There's that idea out there, of course, that private credit and these private firms in general are eating the lunch of some of these banks.
They are. So you want to be more creative in financials. A good name, more in the small mid-cap areas, Houlihan Lokey. They do mergers and acquisitions. They do restructuring, and they do valuation. They're number one in all three of those key business segments. It's a financial that I want to own, pair it up with Ares, maybe pair it up with a Stifel. And while banks have had a good run over the longer term, they're not as great a wealth creators as being more creative within the holdings you own in financial stocks.
I want to ask about small caps and the right setup. You've been in this market for quite a while, David. You were just telling us during the break you had a Bloomberg terminal on your desk since 1993. What's the right environment in which you see small caps really prosper? Is it, going into an economic slowdown, coming out of an economic slowdown when rates are being lowered? Obviously, high rates are difficult for small caps. What do you see as the perfect setup for small caps?
The perfect setup has been prevailing for the last few months. Valuations are attractive. Interest rates are still likely to go lower than higher. Earnings are beginning to reaccelerate for small caps. They've lagged large caps significantly in the last several years. So I think the opportunity set is very good in small cap underfollowed names. I'll give you one real quick. National Cinema Media, they do the advertising in movie theaters when you're a very captive audience before your Wicked movie comes on. They're in about 1,700 movie theaters. Underfollowed, only 4 analysts. Zero debt coming out of bankruptcy. There's a small cap idea among many that I think will look to add value in the next year.
Yeah, that is wild. Also, the Wicked movie has just been so overpromoted. I feel like I can't escape it, but that's a different...
I have my tickets already.
Really?
Yeah.
No kidding.
I've got tickets for Wicked and for Moana 2.
I will see it, but I want to stop seeing ads about it, commercials about it. In any case, David, I want to talk a little bit more about small caps. Of course, you can get so specific for us, which is great. And something that I've been thinking about when it comes to the small caps is that you're not seeing the supply of small caps necessarily get replenished. As you have these smaller companies go up in market size and graduate out of some of these indexes, you're not seeing those small cap IPOs come through. What do you think is the medium and long-term impact on the space from that?
I personally don't worry about it that much. I mean, you still have over 2,000 to 2,500 companies that you can look to find value in a 50 to 60 stock portfolio. If you get more IPOs, that's going to be good. What will get me especially excited is, as investors say, this asset class, since the rotation began on July 11th, small caps are up 16%. They're up again quite healthy today. The Magnificent Seven, it's up only 3%. I think we're in about the top of the second inning for this rally in small and mid cap stocks.
All right, another reason to keep up the Russell 2000 in place of the Dow. David, thank you. Have a great weekend. That is David Sowerby of Ancora. Meanwhile, let's get a look at the stocks moving at this hour. We'll do that with Abigail Doolittle.
Well, it's another down day for Google. Alphabet, it's been a rough week, down 4%. This, of course, on breakup fears. And this week in particular, the DOJ asking a federal judge to force them to sell Chrome. So investors not liking that possibility. The stock down on the week, the most since early September. We also have the shares of Intuit lower on the day, but off the lows, the pre-market lows at least, actually back pretty low, down 4.2%. This after the maker of TurboTax basically gave a second quarter forecast for adjusted earnings that came in weaker than expected. Some analysts are broadly positive, but investors clearly taking some chips off the table on that disappointing outlook. And then finally, one of the big winners on the day, clearly the Gap, and then we also have Ross Stores. The Gap off of its highs, but nonetheless still up 9%. They put up a great quarter, beating adjusted earnings by 25%, but it's really the guide for the full year. They're now looking at sales comps growth of up to 2% from the previous view of up to 1%. So investors will take that. And Ross Stores, better than feared. Well, that has that stock, Katie, up 3.6%.
All right, not bad. Abigail Doolittle, thank you so much. Now, coming up, Manulife CEO Gori set to retire in May. Our exclusive conversation with the insurance head next. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Former Florida Representative Matt Gaetz abruptly withdrew his bid to become Trump's attorney general yesterday. Gaetz is facing scrutiny amid ongoing revelations of alleged sexual misconduct involving an underage girl. Gaetz has consistently denied wrongdoing, but his departure is nonetheless a setback for Trump. And there's more. Just Google it. At McDonald's is overhauling its value menu. The fast food giant is trying to turn around a series of sluggish quarters where the brand lost some of its reputation for value, according to its CEO. The new McValue menu launches on January 7th and will extend the company's recently introduced $5 meal deal into mid-2025. And most Americans think there is a secret to financial success, but how big a salary defines that success? According to a recent survey from Empower, the average successful salary, what's viewed as success across the population, is $270,000 per year. Breaking the data down across generations paints a different picture, though. For boomers, $100,000 is adequate for success, but for Gen Z, they think you need to get paid $588,000 a year to be considered successful. That's massive.
It is massive. We could do an entire segment on that, and hopefully we will at one point. But let's switch gears right now, because Manulife CEO Roy Gori is retiring in May of next year. Now remember, during his tenure, Manulife focused on de-risking the business, and the company stock surged to an all-time high. He will be succeeded by Phil Witherington, currently head of the company's Asia business. And I'm pleased to say that Roy joins us now in an exclusive interview. And Roy, I'm going to ask you a question that I'm sure you've gotten a lot over the past week. And that is, why now? Was this your choice to retire?
Great to see you again, Katie, and thanks for having me on. Let me start by quoting a famous Indian cricketer, Vijay Merchant. He said, "Retire when they ask you why, not why not." And I humbly hope that more people are asking why versus what not. And when I sort of reflect back on the almost 8 years that I've been in this role, I always knew that I wanted to retire when I had three ingredients in place. One was having achieved the transformation that we set out to achieve when we embarked on the next chapter of Manulife's history. The second was around having good business momentum, the wind in your sails, so to speak, and more wins ahead of us in the future. And then the third was having an awesome leadership team in place and a great successor who would not only continue the momentum that we've had, but help take the business to new heights. So it was really, with those three ingredients in place, I felt quite proud to say and decide that this was the perfect time to hand the reins and to move on to new things.
Well, I definitely appreciate that perspective, because so few people actually time it right and actually do go out on top here. But I have to dig in a little bit, because you're only 56, Roy. Is it possible that in a couple of years we could see you pop up at another company, maybe in another industry?
Look, my plan at this point is to do all those things that, quite frankly, I haven't had time to get to. And, one of the things that I'm passionate about is giving back to the communities that I operate in. So, doing a whole lot more philanthropically is certainly one of my passions, and certainly one that I share with my wife, and we want to really dial that up. The second thing that I'm really interested in, and we spoke about this the last time we met, Katie, was just the focus on health and longevity. There's some awesome founders, leaders, entrepreneurs that are doing some amazing things in that space. And I'd love to not only invest in those companies, but also help the founders really build their business. I think too much of our current system is focused on dealing with poor health as opposed to preventing poor health and actually creating good health outcomes. So that's an area that I'm really personally passionate about, and I'm going to spend a lot more time on. And the thing that I love about my job is the opportunity to mentor up-and-coming business leaders. And again, that's something that I'm going to be able to dive much, much deeper in.
I think that dovetails pretty nicely with your business, Roy, because one of the things that you've done at Manulife is de-risk your long-term care portfolio. And, it's just demographics. There are going to be a lot more people getting much older than me and you, and they're going to need to deal with it somehow. What do you see as the future of long-term care in your business, in insurance and reinsurance? Is it just too costly at this point?
Matt, that's a really good point. And we actually this week just announced another long-term care transaction. We did one last year in December, in fact, and it was the first time that a long-term care transaction was done in many, many years. And ours was the largest ever. And it took the market a little bit by surprise. And I think it opened up the market for transactions. And it set us on a run of other transactions. And we completed another one only this week on a younger block of business. So again, I think that really talks to our progress and the business momentum. But to your point, you know, one of the big issues that I think we have in society is that people are living longer, but they're not necessarily living healthier. 20% of the average person's life is lived in poor health. And that's not a good outcome. That's bad for companies like ours. It's bad for society and for individuals as well. So I really do believe that we have to change our paradigm of thinking about health from one that's reacting to issues and problems and trying to minimize them, but rather proactively dealing with the situation so that people can live longer lives, but also healthy lives and lives that are more fulfilling. So I think this is really an important focus for us in the next few decades, and it's certainly front and center for us in our business. But I'm personally passionate about this, and there's some great founders, leaders who are doing a lot of great work in this space, and I'm excited about working on that.
Yeah, we'll definitely have to keep in touch, you know, in that next chapter post-May. But coming back to Manulife, you mentioned these large reinsurance deals. You just mentioned another deal that was announced this week. Is there still more to do? When you look at Manulife's business, is there still more reinsurance, more of these sorts of transactions that are left?
We think so. Well, if I look back, and you said this in the beginning, Katie, you know, when we set out to transform Manulife, we wanted to really transform our business, not only to being the digital customer leader in our industry, and I've talked about the fact that our industry is typically quite manual, paper-based, and not the most customer-friendly industry. And that was a big part of our focus early on, was really becoming much more customer-centric, and we've made a lot of progress. We took our NPS score from +1 to +26. And we have more to do there. But the other part of our transformation was about moving from being a low return, high risk business to lower risk, higher return. And part of that agenda was freeing up capital that was dedicated against legacy businesses that were high risk and low return. And over the course of the last 8 years, we have, in fact, freed up $12 billion worth of capital and improved the ROE of our business from 11% to 17% almost in Q3 of this year. The short answer to your question on future transactions is that, yes, I think there are more opportunities. In long-term care now, I think that there are many more buyers, and that I think bodes well for the industry and certainly for us as we look forward. But actually, I'm also quite excited about our organic ability to manage these businesses better. And it touches on what we were just talking about, this idea of actually helping people live healthier and maybe in their homes for longer. There's the technological advancements that take place mean that people can actually stay at home longer, and that's a good thing for them, and it's certainly a good thing for us as well. So yes, I do think there are more transactions to be had, but there's a lot of opportunity for us to manage the business organically for better outcomes.
Yeah, well, that gets into, you know, having people at home for longer, gets into the caretaker economy, and caretakers are often ignored in our society. But again, underpaid. That's a different conversation that maybe we'll be having with you soon, Roy. But I do want to talk a little bit more about the prospect for M&A. Like you said, you see a lot of opportunities for organic growth here, but the stock is at an all-time high. The business is doing well. If Manulife were to look for acquisitions and targets to buy here, what would be the profile?
Yeah, great question, Katie. So firstly, we're very well capitalized. So I think we're in a position, a very strong position, where we can deploy capital to acquisitions. We've got a very unique footprint, and I've said this many times, that actually with the footprint we have, strong presence in Asia. Asia represents 44% of our earnings now, but then great businesses here in Canada and the US, as well as in Europe. Organically, we think we can grow earnings per share between 10 to 12%. And that's a target that we've actually declared and put out there to the street, together with our target of improving ROE to 18% plus. So we're in a strong organic position to grow and deliver good returns. But with a strong capital base, we can also deploy capital to M&A. And, I guess the top priorities for us would be to look at Asia as an area for us to continue to get scale. We already are a top 3 Pan-Asian player, but also our global wealth and asset management business. We've got a very unique business, and we want to continue to grow that business and have it represent a bigger part of our franchise. And there are specific capabilities that we'd love to acquire. We did a deal recently. In fact, CQS was a transaction we recently completed, and it's provided us with some new, exciting private capabilities. And I think the market's evolving such that private capabilities are going to continue to be much more important.
All right, Roy, thanks so much for joining us. Manulife CEO there, Roy Gori, talking about his business and his decision to retire. I will say congratulations. I mean, going out on top for certain. The stock is up more than 50% year to date, 130% over the last 5 years. So leaving your shareholders happy. Roy Gori there from Manulife. Still ahead, a smarter Siri. Apple is developing a new version of its voice assistant powered by artificial intelligence. Details on whether Siri gets smarter next. This is Bloomberg. SharkNinja, the maker of everything from blenders to vacuums, is hoping consumers ninja the holidays. The company offering a softer than expected outlook for the quarter. Here to talk about more how the consumer is feeling as we enter the busiest shopping season of the year is CEO Mark Barrocas. And we show the 1 month chart there, which I don't think does your stock justice. I mean, it's doubled year to date, Mark. So you've done incredibly well as you release more and more products. But I wonder, does the holiday season matter as much since now, like, every day is Black Friday?
Well, look, first, thanks for having me. And absolutely, the holiday season means a lot. Christmas comes once a year, and this is a tremendous gift-giving time for consumers. The holiday season, though, is very different now than it was 10 years ago or 15 years ago. As you said, for us, the holiday season starts all the way going back to the beginning of October, and it lasts, all the way through December 25th. But it's a period of time where we have a lot of new products coming to market. Consumers are really engaging with us tremendously on social media. And it's an exciting time for us over the next 6 to 8 weeks.
So the holiday season, it still exists, even in this nebulous sort of world that we live in. I do want to talk about the calendar year 2025, and I want to talk about tariffs, because we did show that 1 month chart, and one of the jitters around your stock specifically has been the potential threat of tariffs and what that would mean for the business. You take a look at some of the sell side reaction. You have Jeffrey saying to basically look past it, but give us some details on what it would mean for your business should we see tariffs of up to 60% when it comes to China.
Yeah, well, we've been preparing for tariffs now for the better part of 4 years. We started diversifying our supply chain 4 years ago. We have tariffs today on 35% of our overall products coming into the United States, and it's had no material impact on either our gross margins or on our average sell prices. By the end of the second quarter of 2025, we'll be able to produce 90% of our production outside of China. So we're doing everything that we possibly can on the buy side. And on the sell side, we believe we're not in the opening price categories within the market. Our products are in the mid to upper price categories. And as tariffs went into place last time, we were able to take a little bit on the sell side as well. It's not something that we want to do. We want to be able to manage this on the buy side. But we feel like with our diversification outside of China, it puts us in a really good position over the course of the next 6 months. And things are uncertain, but, we believe we'll be able to manage it on both the buy side and the sell side.
Where are you putting your production? I mean, moving it out of China, does that mean to Vietnam, to Mexico, Texas? Like, where are you making these things?
So it's a number of countries. I mean, Vietnam, Thailand, Malaysia, Indonesia. Southeast Asia has been the main focus of where we've moved manufacturing out of. And as I said, we started this process 4 years ago. And today, we've really been able to build the supply chain at scale in these Southeast Asia countries.
And we'll move on to some of your products, but I just have one more question. You talk about shifting outside of China. You went through some of the countries. How expensive would it be to make all your products in the U.S.? Is that a conversation even worth having, or is it prohibitively expensive?
It really is. I mean, the average sell price for our products is somewhere between $199 and $249. And there just isn't a developed manufacturing base in the United States. We're continuing to keep looking at it, but our products and our industry really moved out of the United States over 20 years ago. And so, while we're exploring ideas and things like our coolers, we believe it would still be very challenging to be able to do that in some of our other product categories.
All right, really fascinating color there. And of course, it helps explain why now we're a services economy. But Mark, let's talk a little bit more about SharkNinja and your portfolio of products that you have. I'm looking through some of your notes. You've launched 25 new products in 2024 alone, which is just an amazing pace there. When do you decide to kill a product, though? What does that decision look like on the other end?
Look, in consumer products, a product has its life cycle. Products, they're successful and they go up, and then there's a life cycle of the products. And our job is to continuing to keep innovating. And as you said, we launched 25 new products this year. About 20 of those products have been in existing categories. We've developed new robots, we've developed new cordless vacuums, we've developed new heating, cooking appliances, new outdoor cooking appliances. And then we've also entered into lots of new product categories like outdoor coolers. We just launched in the UK our first skincare device, an LED infrared cryo mask. We're launching new products in the hair care space. It's interesting, SharkNinja is the fastest growing outdoor cooking company in the world right now, and we're the fastest growing hair tools company in the world. We're in 34 different product categories, so we're innovating in lots of areas, both inside the home and outside the home.
How do you make a product viral, Mark? I think, this is something that you could have a TED Talk on, but is there any way to tell us in a couple sentences what you do in your marketing that gets the message across to so many potential buyers?
Well, it starts with solving a consumer problem. Is there something the consumer is doing outside of the home that they're not doing inside of the home? An example of that would be like our Ninja Slushie product. They're buying those products outside of the home. They're not able to get it inside of the home. In other cases, it's a situation where we're solving a problem that the consumer, a known or unknown consumer problem that they have, like a brush roll on a vacuum cleaner that wraps hair, and they'd like the brush roll to not wrap hair. So it starts with this disruptive, consumer-focused product innovation. We then need to be great storytellers, and we need to tell those stories. And we do a really effective job of telling it in lots of different places, on TV, on social media, on experiential events. And I think what's interesting that you'll find is, if you look at last month on social media, our Ninja Creamy product, 99.5% of the content that was on social media on the Ninja Creamy had nothing to do with SharkNinja. It was all user-generated content. So we kind of light the flywheel, and then consumers start engaging with our products. 15 years ago, consumers engaged with our products by writing an online review, a 5-star online review. Today, they go and they do a TikTok or an Instagram post and tell 10 million of their closest friends why they love this product and why they should buy it as well.
Do you get around, or do you look for new places in the home to innovate? I mean, there's only so many appliances I can keep in my kitchen and my bathroom. Do you start to look in the garage or the basement? I mean, you get where I'm going, right?
I mean, look, we went outside of the home. I mean, what people were talking to us was all about what do we do inside of the home. We're in outdoor cooking. We make indoor-outdoor fans. We're in coolers. We're expanding into more and more categories outside the home as well. The garage is a great place. We expanded from hair care into skincare in the bathroom. There are lots of other places for us to be able to go. So we're in 34 different product categories. We've entered into 12 new categories just in the last 3 years. So there's a lot of places for the Shark and the Ninja brands to continue to expand into. And we're fortunate that both the consumer and the customer, our retailers, have been willing to go on this journey with us into these different categories.
All right, Mark, it's going to be really fun to follow what categories you enter next. So please keep in touch. That, of course, is Mark Barrocas, the CEO of SharkNinja. Let's get a check on these markets about an hour into the U.S. trading day. We'll do that with Abigail Doolittle.
It's worth noting, Katie, that we do have the Trump trade back on. This is a weekly board of the major indexes here in the U.S., and you can see nice gains. The S&P 500, NASDAQ stocks, and Russell 2000 all higher. The stocks sort of surprising, only given the volatility for some of the stocks below, for those chip stocks below. This is not the best week in such a long time because, of course, 2 weeks ago we had the big election rally. Those were the best weeks of the year for many of these indexes. And I would note the Russell 2000, those more domestically based companies that could benefit from a possible protectionist stance from the upcoming Trump administration, well, it is outperforming. Speaking of the Trump trade and outperforming, let's take a look at Bitcoin, now up for a fourth week in a row, and over this time period, up a stunning 46%. Close, very close at this point to $100,000 per Bitcoin. The technical suggesting that it's likely it might blow through that and then back off pretty quickly. And then finally, such an interesting week for retail, Matt. I think that this really tells the story. Walmart up 7.2% on the week. A great week, great quarter. They boosted the outlook. Higher income consumers going there to find value. Target, on the other hand, down about 18% on the week. Miserable quarter. They missed in a big way. They had to pull the full year guide down significantly. The holiday season, that all important holiday season quarter that we're in now, a little bit disrupted here. We really have two tales of retail between these two big box retailers, and that's been the story for a while now. It's hard to tell exactly what's going on with the U.S. consumer and some of the big stores and retailers that we follow. Yeah, very interesting. It looks like maybe Target is losing some market share to Walmart. Obviously, consumers, higher end consumers are shopping down, but not going to Target as much as they would have for home goods. Coming up, we're going to talk about the business of speed, happily for me. McLaren Racing CEO Zak Brown discusses Formula One ahead of the Las Vegas Grand Prix in today's Wall Street Week conversation. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. We do want to bring you some breaking news. This on Meta. Meta must face an investor suit after the Supreme Court drops its case. The U.S. Supreme Court dismissed an appeal by Meta, leaving it to face a lawsuit that accuses the company of misleading shareholders about the data harvesting scandal involving political consulting firm Cambridge Analytica. Remember that investors claim that the company, then known as Facebook, this has been going on for a while, it accused them of inflating share prices by failing to adequately disclose the risk that its user data would be misused. Shareholders say that revelations about the scandal contributed to two 2018 price drops that cost the company more than $200 billion in market value. So to recap, of course, the U.S. Supreme Court has dismissed the appeal by Meta, now have to face that investor suit. You take a look at the share reaction. Not too dramatic right now, but we'll continue to keep an eye on that one. But it's time now for our daily Wall Street Week conversation. And this weekend, Formula One races through Las Vegas. Last year, McLaren Racing reported profits around $38 million. That's up from a loss of around $12 million in 2022. David Weston spoke to the team's CEO, Zak Brown, about all the components that go into Formula One racing, including the people building and driving the cars.
There's lots of different wins you need to win in Formula One. It's all about people. Obviously, we're in technology business. It's about never giving up. It's about incremental gains every single day and learning from your mistakes. And you're constantly making mistakes. You need to win with people. So you need to be a great employer and have a great work environment, take care of people and their families. Of course, we need to have state-of-the-art technology. We need to have great commercial partners, because they're the ones that are the big financial contributors to us being able to get the greatest technology and hire the best racing drivers. And with a Formula One team, if you don't have all of that put together, you're not going to win. And in our sport, you lose more than you win, so you better get used to that and get ready to respond for the next race.
As you say, it's all about people in the end. How competitive is it to get the team that you need? We all think with the drivers, but there are large teams of engineers and mechanics behind the scenes. How much competition is for that talent?
Huge. That's probably one of the toughest parts of the job is getting the right team assembled and then sticking on to them, because when you're at the top, everyone wants to hire your people because they want to know what McLaren got in their race car today. We want to attack their aero department or their engineering department or their commercial department, which is what we all do. You know, we have some people that have recently joined us from teams that have been winning the championships recently because we want to bring in that secret sauce. So I believe you lose people. People don't kind of steal people from you. I expect the other teams to be calling my sponsors, calling our team members, and so we need to create an environment that people want to be here. Of course, you get into contractual situations, but at the end of the day, we're of the opinion we want you to be here. We're not going to force you to be here. I think we're fortunate with the McLaren brand that if you want to be in Formula One, you kind of want to work for a McLaren or a Ferrari. So that gives us a bit of an advantage, if you'd like, that we're able to attract and retain awesome talent that we have here.
You are a competitor. You, in fact, are a race driver yourself. You came up through those ranks. How much difference does it make in terms of money, how you finish at the end of the year?
Quite a bit, tens of millions. Now, in saying that, we're all here to race. The money just happens to come on the back of success. But we wake up, we want to win, we want a trophy. But you get into the way Formula One compensates the teams is based on the Constructors' Championship. So the difference between first, second, third, fourth, down to 10th is quite significant. Then a lot of our sponsor partner contracts will have performance-related bonuses in it. So it's significant difference to go from winning the championship to, say, fifth. But I can tell you, everyone around here is more interested in the trophy cabinet behind you.
And that was David Weston speaking with Zach Brown. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, we're seeing extreme volume and value traded in shares of MicroStrategy recently. Let's take a look at a 2-month chart of MicroStrategy versus Bitcoin. This is amazing. It's outpacing the crypto by a wide margin. Shares are up nearly 500% year to date. And on top of that, MicroStrategy shares were trading more than NVIDIA yesterday when Wall Street was reacting to NVIDIA's earnings. So something is afoot. Let's try to figure it out with Bloomberg Intelligence ETF analyst James Seyffert. He joins us now. And James, there's this theory that's going around, I've seen it on Twitter and other places, that you have these leveraged MicroStrategy ETFs, and we've seen insane volume, insane trading there, and the logic goes that you're seeing all that buying power. Perhaps that could explain this insane premium that MicroStrategy has to Bitcoin itself.
Yeah, I mean, I'm sure that they're definitely part of a piece of the pie, if you will, right? I mean, every time there's money pouring into those 2x leverage ETFs, that is money that is buying 2x basically the exposure of MicroStrategy, so that's driving up the price. Recently, we have seen some money pour into the 2x inverse, so a couple $100 million has come into that over the last week, so it's starting to, flip to the other side. But the one thing I will say is those products, those trading vehicles, these leverage products, what we usually see, and this is different from typical ETFs, is as the product does really well, as the performance goes up, money pours out, people basically take profits, and as it goes down, people try to bottom call. That really isn't happening too much just yet. I will see if that starts to happen, but for the most part, these are bucking that trend of what we're used to seeing with these leverage and trading type vehicles in the ETF wrapper.
James, I was looking at the description page for MicroStrategy, and I see that they have more than 1,600 people working there. Why on earth would you need that many people just to buy and hold Bitcoin? Couldn't, one guy do that by himself?
I mean, you got to remember, MicroStrategy is a multi-billion-dollar operating company outside of what they own for Bitcoin. I mean, right now the market cap is somewhere around 90 billion, I believe. They own $33-ish billion worth of Bitcoin. So you tack on even a generous multi-billion-dollar to the valuation to the operating business and you're still trading at a massive multiple, I think you can make the argument that, like, yeah, maybe all those people and this multiple is a little bit much. I can make the argument that maybe there should be some sort of premium there. It could also trade at a discount.
James, they're trading at 300 times earnings.
Yes, I mean it's crazy. I mean the way Katie showed the chart, it's just absolutely insane to look at. I mean you can look at just the chart of Bitcoin, that's insane to look at, and then you look at the fact that this is basically a leverage play on that. What I would say is that reminds me of like kind of the way the Grayscale trust products worked. In bull markets, when things were running, those things went up to massive premiums. But when you know that flywheel stops spinning and prices start going down, they can actually flip into massive discounts. So we'll see what this looks like going forward. But yeah, this thing is trading at a massive premium to the underlying value of the Bitcoin that it holds.
That's true. In some ways, it's trading just like an extreme example of a closed-end fund. But let's talk about how ETF issuers are capitalizing on this. It feels like there's been this race for leverage in the U.S. You do have 3 times leveraged products in Europe. That's not currently allowed in the U.S., but there's at least 2 issuers who are trying to push the buck here.
Yeah, I mean, MSTU and MSTX, both from Defiance and T-Rex, and each of them also have the 2x inverse options. Then you also have Yield Max, which is MSTY. I mean, this whole ecosystem solely around one stock. There's 5 ETFs. I mean, there's like $6 billion there in this industry. So, I mean, we're seeing this spin up around a whole bunch of other things. I mean, Nvidia is the poster child right now. Previously, it was Tesla. So anything that's really volatile, really moving quickly, these issuers are earning a lot of money on these ETFs. I mean, these things are charging over 1% fee. So there's a lot of indie issuers with really unique, distinguished ETF products out there that are just like looking at what's going on with these products that are simply, you know, creating 2x leverage on an individual stock with swaps, and they're earning over 1% a year on the billions of dollars that are pouring into these things. So it's another win for the ETF industry, but I'm sure there's plenty of other people in the industry that are just licking their chops and trying to figure out a way to get some of the money.
Yeah, it's like Frankenstein's monster, except everyone's making a lot of money. James Seyffert, thank you so much. And tune into ETF IQ every Monday at 12 p.m. Eastern. We'll also have a special ETF show on Wednesday. Nouriel Rubini joining us to talk about his new ETF. There's a lot to talk about.
So wait, that means next week, ETF IQ is going to be on Monday.
Yeah.
And on Wednesday.
Yeah, ETF 1 and ETF 2.
That's excellent.
I know. I'm really looking forward to it. So everyone should tune in then. And they should also tune into Open Interest next week. It's going to be good as well. We have some good guests, at least on Monday.
Yeah. Well, and Bloomberg Business Week today.
Oh, I won't be there.
Tune in from 2 to 5 p.m. I will be anchoring Bloomberg Business Week today. This is Open Interest next week. We have Liz Young from SoFi, Paul Quincy from JP Morgan, and Jeff Jones from H&R Block. This is Bloomberg. Have a great weekend.